This is Will McCauley with Santellect. I'm going to review this week's proprietary natural gas research and analysis looking at the U.S. supply challenge. I think by now everyone in the market is aware of the significant gas storage deficit that we are currently in entering the winter heating season in the United States. So we're going to set that aside for a second. I think people don't necessarily appreciate what the last 4 weeks of draws have been. We've been drawing around 46 to 47 BCF more per week than you were last year. So the deficit has only continued to widen at the beginning of this season. Really what we're going to talk about today is what kind of natural gas production is really required to A, normalize storage in the United States, and B, offset the potential demand drivers that are coming next year in the form of Mexico exports and LNG exports. Our analysis shows that U.S. production needs to grow 10.2 BCF a day year on year next year in order just to offset the growth in exports, both via LNG and to Mexico. Now this jump does not include the other gains required to actually normalize storage from where we are today. So we're down a little over 700 BCF year on year in storage. So we need additional production to offset that low starting point that we have. Those two factors really lead us to the conclusion that storage in the U.S. is not going to normalize in 2019. It's not going to normalize in 6 months. It might not even normalize in 12 months. It really depends on how cold this winter is and what the both directed natural gas production in the United States is and what the associated gas production is in the United States. In the meantime, we're looking fundamentally for gas prices across the strip to rise to $4 to $5 levels that you're seeing in the near-term months this winter. At some point, the market's going to realize that we're exiting the winter season at a very, very, very low storage level. We're not going to make it up this winter, even in a normal winter scenario. In a very, very warm scenario, maybe, but we think that's pretty unlikely. Here we have a waterfall chart that basically shows the year-over-year causality of the decline in storage that we see. So the total storage from the same period last year is down 712 BCF year on year. The majority of that decline is driven by weather. We had cold weather at the beginning of 2018. We had a warm summer, relatively, and we've had a cooler than last year winter for the first few weeks of this year. So that weather impact alone is 1,300, almost 1,400 BCF of the decline. The second factor that we've seen is coal to gas switching, which is another big factor. That's around 550 BCF. And then the last is the LNG exports that have happened year to date. As we continue to have more trains and more terminals online, that number is going to continue to increase. Now, on the supply side, there's a few other factors, but really the big factor is associated natural gas production of almost 2,000 BCF per day. That is the only reason that storage was not worse than it was coming into this season. So again, we're down 712 year on year driven by weather, which was the primary factor, and we do have strong associated natural gas production, but it's not been enough to make up the weather and export impacts that we've seen. Now if we take a look at this chart, now this chart assumes a normal weather scenario, and from the period that we're at today, we have visibility on both LNG projects coming online and pipeline exports to Mexico coming online. So we know between those two factors alone, you're going to have about 3,700 BCF of demand, 3,900 BCF of demand, coming online in 2019. So giving the benefit of a little bit of solar and wind production, power generation, reducing a little bit of natural gas demand, about 300 BCF. Again, the majority of this is going to have to come from natural gas production growth in the United States, on the order of 3,700 BCF over that period. That is a significant amount of production growth. That's 10.2 BCF a day of production growth on top of the already high levels of production that we've seen year to date and for a number of years leading up. So again, we are very pessimistic that the United States is going to be able to produce that much gas, and we think we're going to be having a similar conversation next year as we end the injection season, significantly below the 5-year average. I'm not sure we're going to be below where we are today, but we are definitely not going to be normalized by next year. So again, summarizing the key factors or takeaways from our research, we need 10.2 BCF a day of production growth year on year to offset known export demand. Again, that will not even fix the deficit of storage that we had coming into this winter and the deficit that may widen as we progress through the winter withdrawal season. So we don't see storage normalizing until 2020, potentially further, and expect the back end of the natural gas curve to react similarly to the way the front end of the curve has this winter. We're looking for a target range between $4 and $5 on the back half of the 2019 contracts, even into early cal 2020. So for our full research and analysis and fundamentals report, please visit us at cintellect.com.